You've decided to start investing. You open your brokerage account, and you're faced with the first big decision. Do you buy shares of a company you love, like Apple or Tesla, hoping it will be the next big winner? Or do you buy an ETF, a diversified basket of hundreds of stocks? This is the classic investing debate, picking individual stocks versus buying the whole market. It's the story of the tortoise and the hare, retold for your financial future. Today, we're going to settle that debate once and for all. We'll break down the pros and cons of each so you can make a confident decision about which path is right for you. To understand the difference, let's frame this as a competition with 4 critical rounds. Round 1, the race for high returns. This is where individual stocks, the hare, shine with dazzling potential. If you had invested $1,000 in Amazon back in 1997, you'd be a multi-millionaire today. Picking the right individual stock can lead to explosive, life-changing returns. That is an undeniable fact. The dream of finding that 10-bagger, a stock that goes up 1,000%, is what draws many people to the market. However, it's crucial to understand something called survivor bias. We only hear about the winners. We don't hear about the thousands of promising tech startups from the 90s that are now worth zero. The path to finding the next Amazon is littered with the bankruptcies of companies that were once just as hyped. In fact, study after study shows that the vast majority of professional, full-time fund managers fail to beat the market average over any long-term period. If the highly paid experts on Wall Street can't do it consistently, the odds for a part-time retail investor are incredibly slim. Now, let's look at the tortoise. ETFs can't compete with that explosive potential. The goal of a broad market ETF is to give you the average return of the entire market, which has historically been around 10% per year. You will never get a 100 times return from a diversified ETF in a short period. So, in the race for pure lottery ticket potential, the winner is clearly individual stocks. But that potential comes with a massive hidden risk. Round 2. The safety net. This round is all about risk management and survival. For every Amazon, there are thousands of companies that have gone bankrupt and wiped out their investors. When you buy an individual stock, you are taking on concentrated, or idiosyncratic, risk. You have a single point of failure. If that company's new product fails, if their CEO gets into a scandal, or if a competitor disrupts their industry, your investment can be permanently damaged. All of your eggs are in one basket. An ETF, by its very nature, is a safety net. An S&P 500 ETF holds 500 different baskets. If one of those companies goes bankrupt, it's a tiny, almost unnoticeable blip. Your overall investment is protected by the success of the other 499 companies. It's the difference between betting on a single star player to win the game versus betting on the entire league to have a successful season. The league will always be there next year. The star player could suffer a career-ending injury at any moment. For safety, risk management, and peace of mind, the clear winner is the ETF. Round 3. The hidden costs. On the surface, both are cheap to trade. Most brokers offer zero commission trades for both stocks and ETFs. The explicit cost of an ETF is its expense ratio, which for the best ones is incredibly low, often under 0.1%. That's just $10 a year for every $10,000 you have invested. The explicit cost of individual stocks seems to be zero. There's no expense ratio. But this brings us to the most important round of all. Round 4. The real cost. Your time and knowledge. This is the round that settles the debate for 99% of people. To have any chance of successfully picking individual stocks long-term, you need to do an immense amount of work. This isn't about watching a few YouTube videos or reading a news headline. Doing the research means acting like a professional financial analyst. It means you need to read a company's 10K annual report, a dense 100-page legal document every single year. You need to analyze their balance sheet, their income statement, and their cash flow. You need to understand their debt levels, profit margins, and return on equity. You also need to understand their competitors, their management team's track record, and the long-term outlook for their entire industry. You have to ask deep questions. Does this company have a durable competitive advantage or a moat? Is their leadership team trustworthy? Is their stock currently overvalued or undervalued compared to its intrinsic worth? And you need to do this for every single stock in your portfolio, every single quarter. When a company releases its earnings, you need to be there, reading the report and understanding what it means for the future of the business. It is not a hobby. It is a part-time job that requires dozens of hours of research every single month. If you are not willing to do that work, you are not investing, you are gambling. Now, what is the time commitment for ETF investing? You spend a few hours researching a handful of high-quality, broad-market ETFs. You pick one or two. You set up automatic investments. And you're done. You can check in on your portfolio once or twice a year to make sure it's still aligned with your goals. The real cost of stock picking isn't money. It's the hundreds of hours of your life that it demands. For time efficiency and simplicity, ETFs win by a landslide. The verdict: the tortoise beats the hare. Let's tally the score. Stocks win on the dream of explosive returns. But ETFs win on safety, simplicity, and the most valuable non-renewable resource you have: your time. While the story of the hare is exciting and glamorous, in the real world of investing, the slow and steady tortoise almost always wins the race. The hare might sprint ahead, but it also takes naps, gets distracted, and often runs in the wrong direction. The tortoise just keeps plodding along, step by consistent step, towards the finish line. Don't just take my word for it. Warren Buffett, arguably the greatest stock picker of all time, has given explicit instructions for the money he will leave to his wife. He said, "My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund." The greatest stock picker in history recommends a simple ETF for his own family. That should tell you everything you need to know. For 99% of investors, especially beginners, the correct choice is to start with a simple, diversified, low-cost ETF. You can let the entire market do the work for you while you focus on your career, your family, and living your life. That is the true secret to long-term success. If you found this breakdown helpful, do me a huge favor and hit that like button. It really helps the channel grow. And make sure you subscribe and turn on notifications so you don't miss future videos where we dive deeper into building a powerful investment portfolio. Now for my question to you, are you more interested in stock picking or are you sticking with ETFs? Drop a comment below and let me know why. Thanks for watching, and I'll see you in the next one.